In this video, let us talk about the difference between a mortgage and a promissory note. When you are at that sign-in table, your title agent is going to give you two different set of papers to sign. One of them is going to be the mortgage and the other is going to be a promissory note. And you may be wondering, what's the difference? I know we usually just run through it at the closing table, but let me go a little bit deeper into it for you today. Again, my name is Josette. If you're new here, I am a real estate agent right here in Tampa, Florida, and I love to turn renters into homeowners. I also love to educate them about the home buying process and talk about things like the difference between a mortgage and a promissory note, because you want to know everything when it comes to buying your house. You want to know what everything means. At least I do. So I figured if I want to know, you probably want to know as well. Let's jump right into it. Most people who take out a loan to buy a home signs two primary documents. They sign the mortgage and then they sign a promissory note. By signing a note, you promise to repay the borrowed amount, usually with monthly payments, right? Signing a mortgage allows the lender to get its monies back. If you don't make these payments, then they can take your house back. So usually when you're buying a house, you think that the mortgage is a loan. But the mortgage is the contract that you sign with the lender to provide collateral for a loan. So it's like, I found this house that I want to buy and I'm going to put up this house as collateral for a loan, right? So the mortgage is the contract that you sign for the house. By signing the mortgage, you are pledging the house. You are saying, I am putting this house up. If I don't pay this loan back, you can take the house. That is what it means. The mortgage gives the lender the right to sell your house through foreclosure and use the proceeds to recoup some or all of the money if you fail to make your house payment. So here are some features of a mortgage. So a mortgage sets out your responsibility for taking care of the property. It tells you you're going to keep the house in good condition, in good shape. You're going to keep homeowners insurance on the house and all of that. The lender records the mortgage in the county records and it creates a lien on the property. That's why it's called the first lien holders, usually the bank or whoever it is that you went through. And they have the legal description of the property so that it attaches to that particular property. Along with standard covenants between you and the lender, the mortgage contains an accelerated clause. What is that? It is that clause that permits the lender to demand that you pay back the loan in its entire balance if you default on the loan. It describes how the lender can take the possession of the property back if you don't pay your mortgage. By signing a mortgage, you are pledging your house as collateral. That's why the lender can put a lien on your house, because you're saying, if I don't pay, you can take the house. Let's talk about the promissory note. What is a promissory note? Because these are, tell you, you're signing two primary documents when you are at the closing table, along with all the other documents that you sign. The promissory note contains your promise to repay the loan amount. The note creates the loan obligation. A promissory note is basically an IOU. Signing it means that you're making yourself liable to paying the loan back. It is written that you're promising to pay the loan back a specific amount, a specific date, like the 1st of the month, the 15th of the month. The holder of the note is the owner of the loan. So the holder of the note is the loan owner. In a promissory note, you have the amount of the mortgage loan, the interest rate, the monthly payment that is required, the fees that you're charged if you're late, and whether or not there is a prepayment penalty. The lender holds on to the note. The note gives the lender the right to collect on the loan if you don't make payments. When the borrower pays off the loan, the note is marked as paid in full and returned to the homeowner. What is the difference between a mortgage and a promissory note? The purpose of the document. So a mortgage creates security interest in the property, like a lien for the lender, while the note serves as the borrower's written promise to repay the debt. The contents of the document. The mortgage describes what happens to the home if the borrower does not make the payment, the lender's rights regarding the home, and the borrower's responsibility for the property. The note describes the loan term, including the interest rate and the repayment schedule. The legal implications. The mortgage gives the lender the right to foreclose if the borrower defaults, whereas the note creates a personal obligation for the borrower to pay the debt. So the lender could pursue legal actions to recover the debt by suing the borrower personally on the note or getting a deficiency judgment after foreclosure if state law allows it. It may sound similar, but they're not the same. The note is your personal commitment to pay back the money you borrowed. The mortgage is the security that backs up that promise. So the note equals your promise to repay the loan. So that's an easy way to remember it. And the mortgage is the lender's protection in case you don't keep that promise. My name is Josette. I'm a local real estate agent in Tampa, Florida. I love helping people turning renters into homeowners. If you're not yet subscribed, go ahead and do that. Hit the notification bell so you know every time I upload a new video.